All right, so today we are going to talk about liabilities, things that you pay on a monthly basis and what counts in the pre-approval of your mortgage and what doesn't. So what do we look at for your debt to income ratio? Obviously, we're looking at your new house payment, but there's a lot of other things and there's some confusion there about what counts and what doesn't.
Right. So for example, when you look at the liabilities, how about like my energy bill? Does that count?
That does not count.
Oh, what about my cell phone?
That does not count.
What about these credit cards that I have?
That counts.
Ooh.
So we use the minimum payments on any outstanding credit card balance. So even if you pay $200 a month, we're only going to use if you are only required to pay $100, we're only going to use the $100 against you for qualifying. Minimum payments on credit cards.
Student loans?
Student loans definitely count, even under most circumstances, pretty much almost all circumstances, even if they're in deferment. We're running into that, more and more where people are in deferment for one reason or another, or they're in forbearance. We still have to count a payment. The payment that we have to count will vary by loan type. Some will allow for lower percentages of what we have to count than others. But just keep that in mind that a lot of people think, oh, well, it's in forbearance and I don't have a payment, or it's in deferment and I don't have a payment for 12 months. It still does count.
Now what about student loans, but my parents make all my payments?
If they co-signed on the loan with you,
Okay.
and they've been making the payments for 12 months, then we can get proof that they've been making the payments for 12 months, and then we would not have to complete
Oh,
that.
nice. That's a good deal. What about, I've got a couple kids, daycare.
So daycare typically does not count in your debt to income ratio, which most people that have kids in daycare can take a deep sigh of relief on because that's expensive.
Really expensive.
However, there is one exception to that rule, and that is a VA loan. VA loans do include daycare expense as part of the debt to income ratio. And one way that something can kind of sneak up on you is if you don't tell your mortgage lender about that, because daycare doesn't show on your credit report. And people don't think to tell us about that, and it can be an issue. So just make sure that if you have daycare expense and you're doing a VA loan only, that you tell your mortgage lender about it.
Okay, so I got a question. I was just thinking about this. So on the VA, when we were talking about it, if it doesn't show up on my credit report, the daycare stuff, how do you know that I have daycare?
That's a good question. So when you fill out a loan application, we ask about your dependents, right?
Okay.
And as part of like the VA forms that you're filling out for a loan application, one of the things that you're required to address is, especially if you have children that are not of school age, so usually 5 or older, because that's pretty easy to explain, they're in school. But if your children are younger than that, and we see that on a loan application, right? You specifically have to address why you don't have child care expense. So that is it's a form that is specific to VA that asks about child care expense, and it's a separate form that you fill out. So, and also we sometimes see it on bank statements when we're looking through those as well. We'll see the big payments coming out and we'll be asking questions, but you're specifically going to be asked about that question. Now, that form is not filled out typically until we send you your initial disclosures. And so if you're doing a pre-approval, that's why it's important to mention it, because it can just like come up when you are all of a sudden under contract, you get this form and you're like, oh, I do have child care expense. And then that can really impact your ability to qualify, because child care expense is expensive.
Especially if the ratios, what we talked about earlier, are super tight, that becomes a big problem.
It does become a big problem. So it's just something to keep in mind on VA loans only. That is not something that would apply to conventional loans or FHA loans or RD loans or any of the other types. It's really very specific to VA.
Okay. And then car payments.
Car payments count.
I'm trying to think of other things that would show up on there. What else? What have you seen on there that
Recreational merchandise, very popular here in the MT. Snowmobiles, jet skis, boats, they all count. Payments on campers.
Yeah.
All those payments count. All your mortgages on your other properties outside of this, if you own multiple properties, if you own, here's a good one that comes up that sometimes people forget to tell us about. What happens if you own a piece of land and you don't have a mortgage on it?
Ooh, yes. It's complicated.
So there's some liabilities we have to count in that,
Yep.
namely taxes. If you own another property, free and clear, we still have to count the taxes and the insurance as liabilities as far as calculating your debt to income ratio. So those are just important things that you disclose on your loan application that I think people sometimes forget about, or they get glossed over, or they forget that they have joint ownership in a farm in Iowa, and that counts. So just keep that in mind when you're talking to your loan officer, that there's things that are really important that you tell us so you don't have problems down the road.
The more we know upfront really will save you in the long term of your loan.
IRS tax payment plans.
Gotcha.
We've talked about that in other videos, but I just like to reiterate that. IRS tax payment plans count in your debt to income ratio.
Yep.
The monthly payment counts. So those are kind of the big main ones. I mean, basically, mostly it's the things that show on your credit report. So your cell phone bill and your utilities and your cable, that stuff doesn't show on your credit report. It doesn't count in this. But there are a few exceptions to that rule. So private loans, if you are paying somebody, a private party, let's say you have an official note with your parents and you're making a $200 a month payment, counts. You need to disclose that.
So lots of things to think about when it comes to liabilities. We'll do our best to try and pull that information out of you, but it's really helpful if you can just pretty much divulge everything that you have that you're paying.
It's hard to ask every single solitary question like, do you have property in a different country? Do you have, all those things are important to just discuss with your mortgage lender so that they can come up with the best plan of attack to get you qualified.